Hi, I'm Benoit Poliquin from Exponent Investment Management, and we're watching the market recap for the first or second quarter of 2024, really the first half of 2024. And we're specifically going to look at, in this video, at the US market, specifically the S&P 500. So let's get started. The S&P 500 is started right under 4,800 at the beginning of the year, and it's basically ended the quarter, the second quarter, at just under 5,500. That equates to a 14% price appreciation, and you can add about 1% in terms of dividend income. What you see here on the left in this column are the top 20 most influential names to the upside in terms of what generated this upside performance, and the detractors or laggards of the S&P 500, though the names that had the most negative influence on this performance. So most US portfolios, exponent or non-exponent, lagged the S&P 500. And they lagged for the right reasons, because of diversification. And some clients, very few, but a few are asking questions, why is that? So this video is going to attempt to answer that question, the underperformance. Why is that? So you can see that the most impactful names here, a lot of them are dominated in technology. So number one, technology. Number 2, 3, and 4 are technology. 5 is pharmaceutical, Eli Lilly with their anti-obesity drugs. And then we go back to technology for slots 6, 7, 8, and 9. And then you can go down the list again in 17, 18, and 19, and 20. So there's a lot of names here that are technology focused. So the US portfolios, basically of the top 20, 12 names are technology. So that's 60% of all the names are focused in one technology, in one sector, that is technology. No portfolio manager with a fiduciary duty like Exponent would expose your US section, if you will, and have 60% of it in one sector, technology. So so far this year, diversification, being safe, worrying about downside protection has really hurt performance and created this significant lag. So we talked about diversification. Let's talk about weightings. We talked about that when we covered the Canadian names. The US situation is even more dramatic. So the first 7 names, Microsoft, Apple, Nvidia, these are the largest weights. Notice how significant these weights are. Microsoft is now 6.5% of the S&P 500. Apple, north of 6. Nvidia, nearly 6. Alphabet, if you add both of them up together, you're at 8%. Actually, they would be number 1 if they were combined. Amazon, then Meta again. So it doesn't until you get to Berkshire Hathaway that not only do the weights start to make more sense from an index perspective, but you're getting away from technology. So most portfolio managers, as I said earlier, would expose an account of 10% in a particular industry. Now, investors in the S&P 500 index are under the impression that there's safety in indexing, when in fact, the index right now is anything but diversified. You have to start your portfolio at number 8 to get any sort of diversification in terms of names. So you'll have here financial, pharmaceuticals, again, technology, banking, retail, financial, oils, healthcare. So you got to start at number 8 to have a diversified portfolio. And the weights start to make a lot more sense. So at Exponent, you might find your portfolio have 1, 2, or maybe 3 of those names, but certainly not in the same weights. And so the question I'm fielding right now is, well, how does this situation resolve itself? Now, that's going to be part of the next video, but here's a hint. So again, we're looking at the top 20 names of the S&P 500, but what I did is I pulled the top 20 at the end of the second quarter of 2014, so exactly 10 years ago. So a lot of the names are the same. In fact, of the 20 names, there's about 9 of them that over. So there's 50% turnover rate. But notice the weights, how different they are. So, the top weighted name is Apple, and it's 3%. It's less than half. And if you really count Google as being 8, it's basically 25% of what it was. So you can see that the portfolio in 2014, the S&P 500, was much more diversified, because you had technology, but then you had oils, and then a little bit of technology, financials, pharmas, banking. So it was much broader than what it is today. So money managers 10 years ago, and this was at the beginning of the bear market, or the bull market. The bull market in the US started in 2013. Case in point, Microsoft. Microsoft between 2000 and 2013 traded in a box and really broke through at the end of 2013. So at the end of 2014, Microsoft represented 1.85% of the index with a market cap of 350 billion. So Microsoft has gone 10x in terms of market cap, so 350 billion to 3.3 trillion dollars. And moreover, its weight of its index has also gone up by a factor of, let's call it 3. So 2 or 3. So really, the question then becomes is the index of today as safe as what people or money managers, or some money managers, I should say, think it is? We believe that this index right now is unsafe. And we're going to talk about it in the next video. But really, concentration like this never ends well. So you can see that the index used to be somewhat diversified, no longer is the case. So that's the other reason why most money managers have underperformed the S&P 500, because it's next to impossible to have this type of weighting in one industry in the same vein. So the next video is going to be about how does underperformance end? And we're going to look at the history of some of these sectors because it's happened before. So thanks again for watching.